Hello, and welcome to Need to Know, your weekly investment podcast brought to you by the experts at Coutts. I'm Sarah Muir, and I'm joined as always by Alan Higgins for our final episode of 2023. Now, each week on the podcast, we look at the three things investors need to know, which might be for the week ahead, but we also look at longer term trends, and we like to get Alan to read the research so you don't have to. So, Alan, it's the final need to know of 2023. I didn't set you any homework for this week. But for those perhaps that missed last week, you will have missed our introduction to Coutts' new CIO, Farhad Kamal. And it was very interesting hearing the two of you discuss your surprises for 2023. But I guess it's that time of year, isn't it?
2024.
Sorry, 2020.
Sorry to talk over you, say.
I know,
you can
right.
tell this is not scripted and planned, right?
Thank you for correcting me. Because I'm about to talk about perhaps reflecting a little bit on 2023. It's that time of year when everybody's kind of looking back. And I guess it was just kind of thinking about 2023 has been a big year for Need to Know, hasn't it?
It is. And yeah, because I think we've got a lot of new listeners, and it's maybe worthwhile kind of showing where it's come from, and also some of the speak, because we have had external speakers we haven't had for a while. I think we'll start that next year, won't we? So if you'd like to be an external speaker, get in touch. But why don't you give a brief potted history?
Yeah, well, because it started actually back towards the end of 2021. Alan kindly came to me and said, look, we need to do something for an app that was used by Coutts clients, which was we wanted to do a little sort of investment podcast. And it was born out of that, and it's grown. And we're a little bit better prepared than we used to be. We used to just go on and wing it. I know sometimes it might sound like we go on and wing it now, but actually we do prepare a fair bit.
We do one
now,
prep,
don't we?
Dirty secret, one prep meeting. Yes, ever since it went on to Spotify, we thought, wow, we actually better at least have one preparation meeting. So we do have one prep meeting, but it's pretty unscripted as podcasts go.
Yeah. I mean, to be fair, Alan, you spend almost every waking moment reading research, reading the FT, listening to Bloomberg, doing whatever. So you're kind of preparing basically 24/7, aren't you?
Yeah, that's one way of looking at it. Yeah, so I've got an interesting piece of research from Morgan Stanley to talk about a little later. So you're right, and so for any younger listeners, people starting their career, one thing absolutely I would recommend is just keep on reading and or listening. Absolutely. That's one of the best ways of learning about investments. I continue to do that.
Yeah. Okay. And you did mention it, external speakers, and we have covered some slightly wider topics. There's just three that I wanted to pick out, in addition to all the great colleagues we have within Coutts, like Monique Wong, who joined us a couple of times this year, Howard Sparks, our US equity expert, Richard Way, our UK equity expert. We also had good friend of yours, James Butterfield. That's right, isn't it? James Butterfield talking about crypto. That was back, for anybody that wants to listen to that. That was from the 28th of April. And hopefully we'll maybe get him on in the new year. We also had, which I think was a real coup, which I was really chuffed about, was Jamie Bartlett. He's the man behind the Crypto Queen, the BBC, the fascinating BBC podcast. Well, actually, a couple of different podcasts now on sort of investment scams. And we had a chat with him about the psychological tricks that scammers play on potential investors, which was fascinating. That, if you want to listen to that, that was from the 16th of May. And then more recently, back in October, 26th of October, we had Ed Nottingham on, who works within the NatWest group, talking about investor psychology, which again was fascinating. Especially, I think it was around that time when, we were going through a bit of a mini correction, weren't we? Well, there wasn't that many a correction. It was quite a big correction, actually. And it was quite interesting.
It was a 10%er. Yeah.
It was, yeah. It was, but as you've said on numerous occasions, you can expect to see one every year, but they still, bring you up short when they do happen. And it was very interesting to get Ed's thoughts on how, as investors, we can all just be mindful of how we're reacting emotionally in that circumstance, and how we can perhaps try to be or learn to be more rational investors. So those are, if you're fairly new to Need to Know, go back through, have a listen to some of those, because they're really interesting and slightly different themes. And as I say, we bring in some external speakers, and something I think we're planning on doing a lot more in the new year.
And don't forget, of course, Ray Monahan. That was a great episode.
How could I forget Ray Monahan? Yes, here are
exactly.
FX Supremo. If you didn't listen to that, actually, now I don't have the date of that to hand, and I should have made a note of that. I completely forgot. But you're right, absolutely. Ray Monahan talking about his career in sort of asset management in FX was that was extremely entertaining. But
it was, because he kind of made the transition from a trader to a salesperson, and it was very interesting hearing the stories of how he used to trade FX and how challenging it is still today trading FX.
Okay, so let's get on then to the things we need to know this week. Now, one of the things that, if you've been listening to us for a while, you'll have noticed is we've slightly stepped back from doing that sort of weekly data update, because we've found that a lot of our listeners don't necessarily listen the day it comes out, and they might listen to it, catch up on a few episodes. You might be listening to this over the Christmas period. So we stepped away from the data and, what central banks are doing. However, I don't think we can have a final need to know of 2023 without talking about central banks, particularly the Fed, that surprised everybody.
I completely agree. So, as usual, you make me focus on three things, and the Fed pivot, absolutely extraordinary. I've been around a lot from the Greenspan days of central banking, when it was hard to discern what was really going on, because they didn't want to tell you in those days. But this was extraordinary. We've got to talk about that. And then I thought, as it's towards the end of the year, Sarah, why don't we have a look at what we did relatively well in terms of views, and also to bring that alive, what do we think right now, but also what did we kind of get wrong? Because hey, we're an investment management organization, we get plenty of things wrong as well. What do we get wrong, and any lessons learned, and also what do we think now? So I think those are the 3 points I think we want to focus on.
Yeah, okay. Well, let's kick off with the Fed then. When I went into the office last week, the day after this had been announced, the first thing Monique Wong sent to me was, Sarah, have you seen the Fed pivot? She was very excited about it.
Yeah, Monique is absolutely spot on. It is huge. And we'll mention it again, because it's one of the things that we've got wrong is not really being in tune with the central bankers. So look, basically, super dovish. What does dovish mean? It means that looking to cut rates. And I'm just going to 3 points that he said. So in terms of the formal minutes, there was a dot plot, which is basically where the participants expect rates to go. That was lower. That was a bit of a surprise. But really what it was his speech afterwards. And I'm going to take out, there was many points, but I'm going to take out these 3 because they're worth repeating. So number 1, we need to start cutting rates way before. So Sarah, he said way before. What, strong language.
Yeah.
Inflation reached its 2% target. So inflation's currently a little over 3. Point 2, very focused on the risk of keeping rates too high for too long. Wow. Very focused on the risk of keeping rates too high. Amazing. Point 3, also discussed at this very meeting, when should they cut rates? So we'll call it a pivot. It's more like a handbrake turn. It's a huge move. Yeah. And the markets loved it.
They did, didn't they? But I mean, I've since seen some people sort of being perhaps slightly critical. Whether are the Fed sort of slightly being kind of pushed into this more dovish language because they're trying to sort of stay one step ahead of markets?
I really don't think so, because previously Jay Powell has basically pushed against any idea of easing of monetary policy. We saw that a lot in the summer, for example. So now I think it's for real. I think they're increasingly confident, and it's all where it could go wrong is the inflation view. But we've spoken a lot about inflation, and I guess we've been moderately on the right side. We've emphasized money supply, haven't we? We've talked about the different theories of inflation. These are all theories, and the importance of declining money supply. So, no, I think it's super important. And Look, I'm just going to talk a little bit. So I mentioned the Morgan Stanley report, and so Morgan Stanley, who are actually still a very bearish house on stocks, but to be fair, they put out a really well balanced report out and said, okay, if this is for real, what happens? So what do I mean by that? What happens when the Fed reduces rates and inflation's under control? So in the last 40 or so years, we've seen 4 of them. So only 4. So they are relatively rare. But we did see it in 2018. And when I was a very young institutional bond manager, 1994. But what happens 12 months later? Morgan Stanley sent the report. The average return is plus 22% for stocks.
Okay.
So you can see that, put simply, if the Fed is right on inflation, and to a certain extent, Coutts, because Coutts are also believe it's right to focus on lower inflation. At least based on history, it tends to be a good time for stocks. And 2018 was the last era. The Fed took rates from 0 to 2.75, and then started cutting. We had a quick surge in markets, but over the year, it was a bit up and down, but over the year, the markets were up 14%. I think that sounds a bit more sensible. Why? The overall market is not cheap. The overall market has been well discussed before. But however, when you take away the Magnificent Seven, I'm sure most listeners know what we mean by those, no? But that's Nvidia, Microsoft, etc. And the market actually looks fair value. You know, do you remember we mentioned the equal weighted S&P 500 before?
We did. Yes, we did.
So the idea behind that is that instead of, for example, Apple having a 7% weighting, it has the same weighting as everyone else, 0.2%. Everything's equal weighted. Well, firstly, encouragingly, it's outperformed the main index by 5% since November. So it's already starting to move. And really encouragingly, equal weighted, which is basically looking at all the stocks, it's fair value. So yeah, I mean, the kind of 14 to 15% number that we experienced in 2018 does look interesting to me. In 1994, when I was a young bond manager, the next 12 months were extraordinary, up 34%. I'm not expecting that, but hey, who knows? So you can see it's very, very significant for markets and very important. Now, some commentators are saying, "Oh, it's all priced in."
Okay.
I mean, I don't know.
I was going to say, explain, because we talk about often, and you hear this often if you're listening to, you know, financial experts talking. They say something's priced in. What does that mean? And then also, and then actually we can discuss whether it's priced in or not. But first of all, what do we mean? And is it the same if we're looking at equities and we're looking at bonds?
No, it's a great question, Sarah, because it's very different. Because in bonds, it's mathematical. It's pretty much mathematical. And one, you know, simplistic way of looking at it is a 2-year Treasury yield, for example, is eight little pieces of 3-month deposits.
Yeah.
And therefore, if current rates are 5.25, and just by way of example, and 2-year yields get as low as say 4%. Then you can literally price in how many cuts are coming. And it's basically, as we stand today, 150 basis points. So priced in bonds is mathematical. But it's interesting you mentioned equities. Completely subjective. We're into, you know, we love a theory here on Need to Know, don't we? We're into theories and subjectivity. You cannot prove anything. And this is where I think people can go wrong and be overly bearish and say, oh, well, these rate cuts are priced in. They probably are to the bond market. It doesn't mean the equity market's not going to delight in these rate cuts. And as I've said many times before, equities are a gross asset. So quite dangerous to go against history and go with it as it happens. The tactical team at Coutts are positive right now. I don't have anything to do with that. I haven't had anything to do with the tactical team for quite some time, as we know, as well. So, yeah, I think looking good for 2024 for equities, high yield, earning risk premium. So receiving risk premium and being compensated for risk in general.
Okay. But I guess what it does prove is, because this came as such a surprise. I mean, because we've talked previous central bank meetings, we often single out actually the Bank of Japan as the one that might spring a surprise. And it's all very kind of very anticipated, very well signposted from the Fed and from the Bank of England and the ECB. I suppose what it does highlight is that the perils of trying to base your investment strategy on what central banks are doing.
Yeah, I think that's fair. And look, certain macro-orientated, especially hedge funds, it's their job to be better informed. But for a firm like us, yeah, we've got to have a view. We've got to follow it. One of the best macro hedge fund managers I know, actually, Alan Howard, when I met him of Brevin Howard, which is a long-established macro hedge fund. Even though it's macro, I was surprised when I asked him about kind of, how does he incorporate his macro view into positions and trading. And he always said to me, and I think he says, look, we have a very good, strong underlying macro view and central bank view, but we're not slaves to it. And I thought that was so smart, not to be slaves to it. Too often we can be absolute slaves to that and that kind of viewpoint, and it just doesn't work. And there's hardly anyone better at macro than Alan Howard. So there you go.
Okay. One final question then, just I suppose to strike a note of caution. If the Fed have got it wrong and they start cutting rates and inflation sort of fires back up again, what happens then?
Fair. Markets will not like it. A correction, a decent correction, and a tightening of financial conditions as bonds and equities sell off. And yeah, markets won't like it. Markets will come to terms with it, but yeah, that is, you're quite right to focus on the bear side. And yeah, there are a number of investment banks out there still who kind of stand by that view.
Yeah. Okay. So in summary, then, the Fed caught pretty much everyone on the hop last week with their pivot. No rate cut. However, very, very strongly dovish language coming from Jerome Powell, talking about the fact that they're going to look at needing to cut rates before they get to their target level of inflation. They're very focused on the risk of keeping rates too high, and that they're already discussing when they should start cutting rates. So really a big surprise for the end of the year. Okay, so that's central banks. We're turning now then to focus a little bit on looking back over 2023 with a sort of a focus then on perhaps 2024 as well. We're going to sort of split it into two parts. I mean, I suppose if there's one thing that's kind of one overriding theme that sort of guided us through this year, it is we have taken a bit of a contrarian view, haven't we? Which is sometimes you get that right, sometimes you get that wrong. I feel like I should highlight some of the things we've got right, Alan, because I want to spare your blushes. So I'm going to maybe
thank you. I'm not very good at boasting. I'll be much better at the second part when we talk about the things we've got wrong. So yeah, but so you're basically saying how we basically advocated stock investing, and there was do you recall even from our clients and a lot of publicity, not just the FT, I think even the Telegraph, I mean nearly all the main papers, the Michael Burry The Big Short. Do you want to remind our listeners of that situation?
Yeah. So, I mean, we very respectfully, because we all, we have a huge amount of respect for Michael Burry, he of The Big Short, who kind of spotted the global financial crisis, the subprime mortgage crisis before anybody else did, or before most people did. But he had, we don't know exactly quite how he'd done it, but we know that he'd basically shorted the market earlier in the year, and I can't remember when it was exactly, which month it was, but it did raise a few concerns amongst our clients and generally amongst the wider sort of financial media about whether was he going to be right again this time? Were we due a sizable correction? We slightly pushed back against that, didn't we? Or you did, certainly.
We did. Thank you. So it was 1.6 billion. That number got referenced. Now, to be fair, that's the nominal amount of options. So he bought basically bearish options, which are called put options. And we pushed back because we pointed out at the time, something called skew, which shows how expensive put options were compared to calls, showed it was a very crowded trade. And also, do you remember, you set me a task, go and find a bullish view on stocks in the
I
summer.
did. Yeah.
I could barely find one. It was so hard to find someone. I mean, most of the main houses, especially Morgan Stanley and JP Morgan, super respect top firms who've called markets well, but they've remained bearish, for example. And it was really, really tough. The person we did find in the end was a guy from Fund Strategy, Thomas Lee. That was one of the few out there. But yeah, we stood by equities, and it was interesting having Farhad on, a bit more forward looking, and because one of our surprises for next year's equities could be double digits, and no one's really focusing on that. The fact that the likes of Morgan Stanley, JP Morgan are still very bearish stocks is a bullish factor.
Yeah.
One other I recall, there was a Goldman Sachs review of their clients.
Yes.
It was over 1,100 clients, and they basically asked them. They set some ranges for the S&P 500, and they said, "How many of you expect the S&P 500 to be over 4,400?" I think it was about 4,300 at the time, and it was an incredibly small percentage. I seem to remember between 15 and 20%. Maybe even lower, maybe something like 11 even. Apologies for not remembering. As again, you can tell it's not scripted, but it's just come to mind. Today, the S&P 500 is circa 4,700.
Yeah.
So it was a really pessimistic year. And to be fair to Need to Know, we did really, we really argued the case against it, didn't we?
Yeah, we did. Yeah, we definitely sort of identified, well, certainly you identified that we potentially encountered sort of peak pessimism, and that in itself was a contrarian indicator, wasn't it? And that was an indicator that maybe they'd gone too far. Yeah,
absolutely. And just bring it, because we want to be forward looking, just like our surprises of last week. We stand by it. I mean, it's not become a consensus yet to be bullish of equities. So it's not just JP Morgan and Morgan Stanley. A lot of our competitors, the likes of Ruffer, I've mentioned, which is well known, very, very defensive in their positioning. So it's still very much out there. And yeah, equities are a growth asset. We've got this Fed pivot. It's hard to argue against equities with this Fed pivot. Yeah, of course, there's a bear case. There's always a bear case. So yeah, stay with it is our forward-looking guidance for 2024. And Sarah, don't forget your heavy disclaimers at the end.
I will. So we haven't quite got to the point yet where bullish is the consensus, and then
Absolutely
when it does, we
not.
might start pushing against it.
Yeah, I mean, look, people who know me, you know me. Am I known as an equity bear at Coutts?
No.
Exactly. So look, I have been bearish. I mean, especially my career, especially 1999, way too early. I think that's the other thing. We featured the big crashes, didn't we?
We did.
And,
yes.
And basically said, is 2023 anything like the big crashes? And we ruled that out by showing how different this market was from the big crashes. It's all coming back to me now, Sarah. All the stuff that we did this year. Still not, 1999 was the only bear market that I predicted, and even then I was early. But look, generally, look, there may be a time for caution, but I would say it's much healthier now with the equal weighted and small caps performing well. It's not just the Magnificent Seven.
Well, that rally has definitely broadened out, hasn't it? Now,
basically, yeah, simple as that.
Yeah. Okay. And on a related note, I did notice that Zoom apparently has dropped out of the NASDAQ 100 now. Those were the days, weren't they? When we were all
those were the days. Yeah.
The other thing then, before we get on to perhaps some of the things that we didn't get quite so right, you were sort of pushing back against this sort of drift towards passive investing and this trend where it was almost becoming the norm now, passive investing, and there was less and less focus on active investing. And are we starting to see that tide turning a little bit, maybe?
Yeah, so kind of a bit of a backstory. So myself and Coutts have long been advocates of passive or index investing, and that's been quite successful. That's It's amazing how, one relatively small decision can have so much influence, and therefore it meant our style had exposure to the Magnificent Seven. And just, was it in October or November, we just went out there and said, it's gone too far. It's now gone way too far. And again, contrarian instincts. One, of course, the expensiveness of the Magnificent Seven. And a lot of amazing companies, absolutely, but they are expensive. One, but two, the weighting of them at 30% in the index, and then what really highlighted, there was an article where I think it was in the FT, where basically the article where some of the mainstream investment managers, the likes in particular, I think it was Aberdeen, who said we're no longer going to basically do global equities or US equity. And I just thought, completely given up, because it has been so difficult. The numbers are something like this: over 5 years, 85% of US equity managers have underperformed. So quite horrendous. Actually, sorry, I just saw an update on that. It was 85, it's moved up to 90%. So it's been really, really tough. So our timing here has been lucky, and it's way too early, Sarah, way too early. But when the equal weighted S&P 500 starts to do better, that's an indicator for active management. When small caps do better, that's also an indicator. By the way, small caps are also doing a bit better in the UK. And just maybe this index weighting that we have in especially in the US market has gone too far. We shall see. By the way, I did say, just in case you're a new listener, what does this mean? So the numbers will go from something like 90% to maybe 60%. So it's still going to be tough for active managers. Absolutely, it's going to be tough. But, maybe we'll see a bit of a normalization. That's where bond managers are, that kind of number, 50, 60.
Yeah. Okay. So then to sort of sum up what we got right in 2023, it was about particularly kind of pushing against that very pessimistic, very bearish view. We questioned it, we challenged it, and it seems, fingers crossed, like we may have been on the right track with that one, that maybe things weren't as bad as people thought, and that consensus bearish mood was probably a little bit over the top.
Okay. Correct. Yeah.
Okay. All right then. Well, okay. In the interest of balance, because we didn't get everything right.
Active versus passive. We're not. I think we should say we're not really celebrating that. That's going to take years to play out. But I just think it's worth mentioning, just because we were lucky. Frankly, it looks like we, temporarily called it with this breadth. But just. We're reiterating it, and I think it can have a real impact going forward. But let's see. That's something for 2024.
Okay.
But let's. What did we get wrong, Sarah?
Well,
so much.
Exactly. Well, our first point of today, we got that one wrong, didn't we? Well, we didn't get it wrong, but we certainly didn't see it coming.
Correct. Yeah. So what do we get wrong? So I can. Yeah. So I think right at the start of the year, the consensus was recession in the US.
Yeah.
We went with that a bit. And people might be listening saying, well, hold on a minute, you just said you were positive on stocks. And I said, yeah, we were, because then we said, okay, yield curve inversion. That's when short rates yield more than long rates. Classic signal of a recession. Kind of hard to go against that. So we'll go with recession. But if you recall, Sarah, we called it the most anticipated recession in history.
Yeah.
And it may be very mild, and therefore it's not enough for us to sell stocks. So we did have this kind of conflicting view, but nevertheless, you could say our core economics view was wrong, frankly, especially at the start of the year. And throwing that all in together, also our expectations for central banks. Well, this Fed pivot we completely didn't see. And also we expected surprises from Japan, didn't really happen. They didn't do as much as we thought. And early in the year, when we thought the Fed maybe nearly was done, they kept on raising rates. So I think it's fair to say, in summary, you could say economics 1 out of 10, central bank Alan Higgins, because I can't blame Coutts on this. Alan Higgins' anticipation of central bank moves 3 out of 10. So there you go. So yeah, I'm afraid there's not much mitigation there.
Okay, I think we're entitled to get the odd thing wrong. I think if there's one thing that characterises Need to Know for me, it's that we don't sit on the fence. I try and sit on
We
the
don't.
fence, but you never do sit on the fence.
Well, because we do try to be forward looking, because that's obviously useful. I mean, it's useful for a bit of analysis of the past. So let's take that. I mean, so what are the lessons? Go back to what Alan Howard said from Brevin Howard. Have a macro view, have an economic view, but don't be a slave to it.
Yeah.
And continue that for next year. So we've just given you an overall economic view that inflation is going to be lower. Don't be a slave to it. You just can't be. Look, we're in the wealth management business here, not a hedge fund, but still important. And similarly, on having a view on central bank policy, important, but it doesn't necessarily drive markets and risk premium. What drives markets and risk premium is corporate fundamentals, typically, and the technicals of the market. And so I feel a bit less bad than getting these points wrong. I think it's fair to say, economy and central bankers, because I guess you could say, well, I remember what Alan Howard said to me, and this is, I'm talking, may have been 20 years ago when I had this chat with him. And it just struck me, and maybe like a little bit of that has rubbed off, some of his genius has rubbed off, and that helped to at least provide the not advice in a wealth management context, but the advice to basically receive risk premium, to be in higher yielding fixed income, to be in equities, and that worked. So, and stand by that for next year. Look, next year, absolutely, we expect the Fed to reduce rates. Okay, big deal. As we mentioned, it's discounted in the market. It's discounted in the bond market, not necessarily in equities. We think equities will like it a lot as the rate reductions come through, and stay with it. And I think high yield and credit investing is going to look very interesting next year, with lower rates also. So looks like a very interesting time. As for the economy, side with Jay Powell, he doesn't see a recession. Obviously, the fact that they're cutting rates makes a recession less likely. So learned our lesson. It's one of those very unusual times where the yield curve didn't work as a signal.
Yeah.
But, we don't always side with central bankers, but I think we're firmly in Jay's camp now.
Okay. So in summary, then, we're saying, reflecting on perhaps some of the things we didn't get quite right in 2023, and then sort of applying that to how we look forward to 2024. Have a macro view, but don't be a slave to it. And, it's important to have a view on what central banks are doing, but ultimately it's not central bank policy that drives markets. It's fundamentals. It's corporate earnings. That's what's important for equities, not what Jerome Powell says.
Well, it's fair. That's nuanced. So absolutely, in the long run, Sarah, everything you said is true. Absolutely, it is all about corporate fundamentals. But I think it's fair to say, quarter to quarter, month to month, Fed policy can be important. And we did have that 10% correction in the summer of 2023 when Jerome Powell was pushing back about rate cuts. So look, it sounds like we're having our cake and eating it here by saying, look, Fed cutting rates is positive. But all we're doing there is taking that Morgan Stanley report as a reminder. We said it earlier. There's been 4 occasions where the Fed has eased policy and there hasn't been an inflation problem, and it's been very bullish, and on average 22%. So I'm going to have to basically say, look, Fed policy does matter. It does matter. The markets don't like higher rates. Markets do like lower rates. But I guess what I'm saying is that if the corporate fundamentals are strong enough, they can deal with the higher rates, which reminds me, because we gave the example, didn't we, of the '03 to '07 period?
Yes, we did.
Do you remember that?
I
So
do.
the '03 to '07 period was when we last had higher rates. And I know these numbers off by heart. And UK rates averaged 5.25%, for example. What did global stocks do? So 5.25% is reasonable on cash, right? Global stocks in sterling terms, 77%.
Yeah.
And even stronger in dollar terms. Was a period when sterling strong. So that was an example where, if you like, monetary tightening didn't matter over 5 years. So you're right there. But that Morgan Stanley piece of research is more a 12-month view. Yeah. So that's when Fed changes can be important. And let's face it, until this year, the market really wasn't liking. 2022 was an awful year, as you remember. Market wasn't liking high rates. But in the end, corporate fundamentals come through.
Yeah, okay. And we'll be coming back to that, because I'm sure in the new year we'll have Howard Sparks back on to talk about US earnings when those are being reported in sort of January time. Well, thank you very much, Alan. I've certainly enjoyed talking to you this year. I hope everybody's enjoyed listening. We'll be back again in early January. I suspect probably on the 3rd of January, because we will do our prep. We'll do it on the Tuesday. So our next episode of Need to Know will be on the 3rd of January. Just all it remains for me to say is my usual reminder that the views expressed in this podcast are not intended to constitute investment advice, are accurate at the time of recording, and are subject to change. So thank you very much, Alan. Have a very Merry Christmas and a happy, healthy, and hopefully prosperous 2024. And I extend that to everybody listening. I hope you've all have a wonderful time, whatever you're doing over the holiday season. As I say, we'll be back in early January with more Need to Know. Until then, bye from me and bye from Alan.
Goodbye, everyone. And thank you, Sarah, so much for hosting. It's been fantastic.